Welcome to the July Spotlight on Insurance and Property Casualty coverage brought to you by ProducersWeb.com. I'm Paul Wilson, and in this broadcast we'll cover some of this topic's biggest trends and most insightful research. This Spotlight on Insurance and P&C is sponsored by Dressander & Associates. We dedicate ourselves to your success. For more information, please visit www.dressander.com. Commercial property casualty rates fell an average of 6% in June year over year, according to data from MarketScout. The downturn affected all lines of coverage, industry classes, and all sizes of accounts, with the largest accounts seeing the biggest declines. According to Richard Kerr, MarketScout's chief executive officer, quote, June renewals show rate declines that continue to moderate, with many insurers waiting to determine how July 1st reinsurance renewals will impact capacity. According to early reports, capacity for coastal property decreased, and property catastrophe capacity in general is going to be tougher to secure, unquote. Kerr added that many insurers are choosing to retain their capacity until risk-return ratios improve, while many major insurers are likely to see poor underwriting results. Finally, he predicted major movement in the market during the upcoming year, with clear-cut winners and losers. The U.S. property casualty insurance industry saw its net income plummet 87% to $1.2 billion due to underwriting losses and investment returns, according to AM Best Company, Inc. For commercial lines, net income fell 52.9% to $1.6 billion during the first quarter year over year. In addition, net premiums written for commercial lines declined 7.8% to $46 billion for the period, while underwriting losses fell from $1.5 billion in the first quarter of 2008 to $500 million for the same period in 2009. Meanwhile, policyholder surplus was down 14.6% to $197.6 billion. AM Best said 2009, quote, is shaping up to be another challenging year. Unfavorable economic investment and underwriting environments are expected to continue straining underwriting and operating results through the remainder of the year, unquote. A combination of the continuing economic recession, unreliable insurance premium pricing momentum, and declining underwriting results means the property and casualty industry will continue to struggle, according to a recent report by Conning Research and Consulting. Clint Harris, an analyst with the firm, says, quote, the combination of continued price decreases in most commercial lines of business and the recession suppressing exposure growth continues a string of negative premium growth for 2009 that began in 2007. But recessionary conditions can suppress losses, including reduced frequency from fewer exposure units and reduced loss severity due to deflation in some property loss cost drivers, unquote. Conning used its industry model to gather data for the report, while looking at industry drivers such as data filings, public insurer reports on first quarter results, and estimates to date of 2009 catastrophe losses. Overall, Conning anticipates moderate deterioration in combined ratios through 2010, with slight improvements beginning the following year. I'm Paul Wilson, and thanks for watching the Spotlight on Insurance P&C. To see more video spotlights on your favorite products and practices, find them on ProducersWeb.com and browse by topic.